Good afternoon, everybody. Happy New Year. My name is Ed Ryan from WorldCupAdvisor.com. We're going to start this year's series of webinars off with Chuck Hughes. We're very happy to have such a preeminent industry trader with us today, and we're all looking forward to a good webinar. So if you have any questions, we will be taking a Q&A session at the end of this. I'm going to start today off by reading a small disclaimer about the risks of trading. Trading stocks and options involves significant risk of loss and is not suitable for everyone. Past performance is not necessarily indicative of future results. Chuck Hughes is a stock trader. He's been involved in many competitions. He trades stocks and options primarily now. Over the years, he's traded many different vehicles, but his primary focus right now is stocks and options. He's a former commercial airline pilot who decided to turn his hobby, which was trading, into his profession. He's been a very successful trader. He won last year's World Cup Championship competition in stocks held with Robbins Trading Company. Very sought-after speaker and publisher and writer of books. So we're all looking forward to a great presentation today from Chuck. And without further ado, I'd like to introduce Chuck Hughes. Thanks, Chuck.
Thanks, Ed. Good afternoon, everyone, and thanks for joining us. This is Chuck Hughes, and welcome to our MVP Secrets webinar. It's great to be here today. Trading stocks and stock options has been very challenging over the past 6 months, but I'd like to share with you the strategies I use on a daily basis to beat the markets. Beating the markets is my life's passion at this stage of my life, and I'm very excited about the profit potential for the MVP strategies this year. My market volatility profit strategies are designed to work in any type of market, including bear markets. As a matter of fact, we're going to cover several strategies today that are specifically designed for bear markets. Share with you today, so let's start with an overview of the MVP strategies and how we set up the trades. The first MVP strategy we will be discussing is the trendline strategy. With the trendline strategy, we use a simple trend indicator to determine if a stock is in a price uptrend or price downtrend. At any given time, there are many stocks in a price uptrend, so then we use a trend confirmation indicator that confirms the price uptrend or price downtrend. This helps us narrow down the list of potential trades. Once we determine the trend and confirm it, then we can purchase a stock or call option if a stock is in a price uptrend. And if a stock is in a price downtrend, we can purchase a put option, which of course profits as the underlying stock declines in price. I just wanted to mention one thing about the strategies. All of the MVP strategies are limited risk strategies, which means you can't lose more money than you invest. You can still lose money, of course, but you can't lose more than you invest or receive a margin call to wire additional funds into your brokerage account. This is important during these volatile periods when unanticipated news events could cause a quick adverse move in our market positions. If we use the trendline strategy and trend confirmation indicator and we decide to purchase a call option on a stock, the option cycle strategy helps me decide which option expiration month and which strike price we should use. And finally, we'll be looking at trading option spreads that I think have the best overall risk-reward profile of all of the MVP strategies. Let's talk about the first of our MVP strategies, the trendline strategy. Now, many times the stock market can seem complicated and confusing. Stocks can go up or down for no apparent reason. Intel reports great earnings, but the stock plummets. The price of oil drops and the inflation report is tame, but the major stock market indexes dive. When it comes right down to it, the reason why stock prices are going up or down seems to be anybody's guess. Now, highly paid analysts would have us believe that a company's fundamentals drive stock prices. Yet, how many times have you seen the stock of companies with good fundamentals crash while those with terrible fundamentals soar? But none of this really matters for one simple reason. Because at the end of the day, if there's more buying pressure than selling pressure, then the price of a stock will go up. And if there's more selling pressure than buying pressure, then the price of the stock will go down. It's just that simple. Everything else is just noise. To make real money in the market, you don't need to know why a stock price rises or falls. You just need to know in advance which way it's most likely to go. If you can quantitatively measure the buying and selling pressure of a stock, then you'll know in advance whether the price is likely to rally or decline. So successful trading can be reduced to two simple rules. Buy investments if the buying pressure exceeds the selling pressure, and we want to sell investments if the selling pressure exceeds the buying pressure. Now, the best way to measure buying and selling pressure is to track the daily price trend of a stock. If the daily price of a stock is increasing, then the buying pressure is exceeding selling pressure and the stock should be bought. If the daily price trend of a stock is decreasing, then the selling pressure is exceeding buying pressure and the stock should be sold. The goal of the MVP trendline indicator is to determine whether a stock is in a price uptrend or price downtrend. We have to establish this before we invest in a stock. Investing with the trend is essential for successful investing. Now, we don't want to buy a stock because it's cheap. I've learned the hard way that a cheap stock can become much cheaper. And a stock's price movement reflects all of the known information about a company. So let the price movement of the stock tell you when you should invest. Now, the best time to buy a stock is when its upward price trend has already been established. New investors tend to purchase cheap stocks that are in a price downtrend, hoping to pick the bottom of the price movement. This is difficult to do as it requires that you correctly predict when the price of the stock will bottom out. Predicting when a stock's price will bottom out can be nearly impossible to forecast correctly on a regular basis. And stocks that are in a price downtrend should be sold. So the price trend will reveal in advance which way the stock price is most likely to move. The historical studies presented in the MVP book demonstrate that price trends tend to continue in the same direction and can continue on longer than one may initially expect. Now, I like to use trend lines to define a price trend. They are easy to use and simple to download, and they can tell us instantly whether a stock is in a price uptrend or a price downtrend. Now, the MVP trendline indicator uses weighted trend lines to define a stock's price trend. And these weighted trend lines can be downloaded easily off of the internet. Here's a daily price chart for Reynolds American stock. And you can see the daily price, open, high, low, close price bars here. And this blue line is the 80-day trend line that I got off the internet. It's easy to download the trend lines. And this shows us obviously that Reynolds American is in a price uptrend. Now, one of the easiest ways to determine whether a price trend is in an up or a down mode would be to plot the fast trend line and the slow trend line and monitor the crossing of these two trend lines. For example, an uptrend would occur if the 40-day trend line crossed above the 80-day trend line, and we would want to buy stocks in this example. And a closing a closing price downtrend would occur if the 40-day trend line crossed below the 80-day trend line. And we'd want to sell stocks in this example. Now here's the daily price chart of Pfizer, and this blue line right here is the 40-day fast line. The red line is the 80-day trend line. And then we have the daily price bars for Pfizer stock. Now we can see that the 40-day trend line crossed below the 80-day trend line right here, indicating a sell for Pfizer stock. And once we get a sell signal like this, we don't want to buy the stock because we don't know how far the stock's going to go down or how long this price trend is going to continue down. So you don't want to buy once the 40-day trend line crosses below the 80-day trend line. And we don't want to buy a stock until the 40-day crosses above the 80-day. Now we can see here that the 40-day crossed above the 80-day, signaling it was okay to buy Pfizer stock again. So monitoring the 40-day and 80-day trend lines is an easy and effective way to determine the current trend of buying pressure versus selling pressure. And just to recap the MVP trendline stock strategy rules, we want to purchase a stock if its 40-day weighted trend line is above the 80-day weighted trend line. And we want to sell any stock if the price of the stock declines 15% or more from our entry price, or if the 40-day trend line crosses below the 80-day trend line, whichever occurs first. Now here's some recent examples of MVP trendline strategy trades. This is a daily price chart for Medco Health, and the 40-day trend line is this red trend line, and the 80-day is the green trend line. And we can see here that the 40-day crossed above right at about the $57 level, and the 40-day has stayed above the 80-day trend line, indicating that the price, or indicating that the stock is still in a buy mode. So as long as this 40-day trend line stays above the 80-day, the stock is a buy. And here's another example. This is for Monsanto. And in this chart, we can't actually see the crossing of the 40-day above the 80-day. That occurred prior to this one-year chart. Now the trendline strategy also acts as a safety switch, and it will tell you to exit a stock if it enters a downtrend, and it can save some pretty big losses if you follow this system, this simple system. For example, the trendline strategy issued a sell signal for Countrywide Financial at 37.20 right here, and Countrywide's currently trading at $4.96. So if you were following this strategy and you owned Countrywide stock and you sold right here, once it entered a downtrend, it would have prevented a 87% loss based on current prices. Now page 11 and 12 of my MVP book contain additional money management rules that we use in addition to selling when the 40-day trend line crosses below the 80-day trend line. Here's another example of a safety switch sell signal. This was for Nortel Networks. The 40-day crossed below the 80-day at around the $60 level, and as you can see, it stayed in a downtrend and would have saved you from considerable losses following the strategy. And again, once that 40-day crosses below the 80-day, you don't want to buy the stock until the 40-day crosses back above the 80-day, because you don't know how long or how steep the decline is going to be in the price. Here's another example of a sell signal for Sun Microsystems. And it sold Sun Microsystems at around the $45 level. And you can see, again, that would have saved you from big losses. Now we're going to take a look at some historical results for the trendline strategy. I used the Omega Supercharts program to perform this historical testing. And the Supercharts program allows me to do historical profit calculations using the trendline stock strategy rules of purchasing a stock when its 40-day trend line crosses above the 80-day trend line, and selling a stock when its 40-day trend line crosses below the 80-day trend line. Now, what I have listed in this table are the historical profit results for a very broad cross-section of stocks in virtually every type of industry from July 1st of 1982, or when a stock first started trading, through July 1st of 2006, which is a 24-year test period. The average test period was about 14 years. Results are based on initially investing $200 in each stock for the first buy signal and compounding the results thereafter, and they don't include commissions. So this sampling includes both growth and value stocks. Now, these historical results reveal that the trendline stock strategy produced impressive profits with very low risk. The total initial capital required to invest $200 in each of these 50 stocks was $10,000. Now, this $10,000 investment generated $341,000 of profit, which translates to a 3,400% return on the initial $10,000 investment. And over the 24-year test period, this return rate allows us to double our initial investment every year on average if you let the initial investment compound. Now, the average profit factor over the test period was 18.7. Now, that translates to more than $18 of profit for each $1 of loss. And the profit factor is calculated by dividing the total losses by the total profits. And it's a good measure of risk. A high profit factor indicates that the trendline strategy has kept our losses to a minimum by exiting losing trades before they develop into big losers. And it maintains winning trades as long as the stock remains in a price uptrend. So the trendline stock strategy almost always exits a trade before a big loss occurs, and it provides us with the discipline necessary to become successful investors. Now, keep in mind that there was 3 bear markets that occurred during this test period, including the 2000 through 2002 bear market, which was the worst bear market since 1932. Now, the MVP trendline strategy works just as well in bear markets. And what I have here is a price trend for the short financials fund. Now, this is a inverse ETF, and this ETF stock will go up when the financial stocks in the portfolio go down. So it's just the reverse of the stocks that are in the portfolio. If the stocks in the portfolio go down in value, the financial stocks go down in value, then the price of this fund will increase. And we can use the trendline strategy to buy this ETF you can see the red line here is the 40-day trend line, and the green line is the 80-day trend line. So as long as that 40-day stays above the 80-day, then this inverse or bear fund is a buy. Here's another example. This is the short consumer services fund. And again, the stocks in this fund have gone down in value. Therefore, the price of the ETF stock, the short ETF stock, has been going up. And again, you can see it's in a trend line buy mode with the 40-day trend line above the 80-day. Now, the historical profits we just looked at show that the MVP trendline strategy produces good profits with low risk. The trendline strategy will guide you to stocks in a price uptrend and will allow us to know in advance the most likely future price direction of a stock. This gives us a big profit advantage over a strategy that picks stocks by trying to predict the future. I've been using a trend following system since the mid-1980s with good success. Now, over the years, I developed several trend confirmation indicators that I'd like to share with you that increase the profit potential and accuracy of the trend following system. At any given time period, there can be hundreds of stocks that qualify as a buy using the trendline stock strategy rules. The problem lies in trying to narrow down this list of buys to a manageable number of stocks that you can trade with a limited amount of trading capital. In my trading experience, I discovered that stocks that are making new 52-week highs tend to continue their price uptrend. A stock that makes a new 52-week high confirms the price uptrend and allows us to narrow down our list, our buy list, to stocks with the greatest profit potential. Now, I literally check this 52-week high list almost every day, and in checking it, I discovered that when you check this list every day, you start to notice stocks in certain industry groups that make new highs almost daily. Now, these are the industry groups I like to focus on to narrow down my list of stocks with the best profit potential. I will then normally buy one stock or option from each of the top performing industry groups. Quantitative research suggests that approximately a half of a stock's price movement is due to the industry grouping of a stock. So that's a good confirming indicator. And focusing on the top performing industry groups provides us a constant tailwind to our trading success. It allows us to not only narrow down our list of stocks, but also provides us stocks with the best profit potential. Now, currently, aerospace, medical cost containment, infrastructure, basic materials, and agriculture are the top performing industry groups whose stocks are making new highs. And of course, the length of time the industry group will remain in the new high list will vary, and normally it's from several months to a year or even longer. And right now, the home builders, mortgage lenders, real estate, retail, and financials are the bottom performing industry groups whose stocks are making new lows. So for these groups, you want to buy inverse or bearish ETF funds or put options. Now, here's another price chart of Medco Health, and this is another example of a stock in an MVP trendline buy mode with the 40-day trend line above the 80-day trend line. And we can also see it has confirming indicators because it's making new highs almost constantly. So it's been giving us a lot of opportunity to enter, and because it's been making frequently new highs. And it's also in one of the top industry groups. So those confirming indicators help me decide which stocks to trade and which ones to pass. And here's a price chart of Monsanto, and again we have the confirming indicators with the stock making new 52-week highs frequently, giving us many opportunities to enter. And also Monsanto is in a leading industry group, the agricultural group. And the trend confirmation indicators also work for bearish funds. We can see this is the short financials fund, and it's making a series of new 52-week highs, which allows us to enter, and it confirms that the financials are in a downtrend and that the bearish fund should be bought. And here's the short real estate fund, again with confirming indicators, making new highs, and it's in one of the poorer performing industry groups, confirming the downtrend of the real estate stocks and the uptrend of a bearish real estate stock fund. The MVP trendline stock strategy has proven to be a successful method for selecting profitable stocks. And the MVP option strategy builds on this success by purchasing call options on stocks that qualify as MVP stocks. When I decide to purchase a call option, I'd like to use historical price data to help me select the time length of the option. Now there's 3 different option expiration cycles. The first cycle is the January, April, July, and October expirations. The second cycle is the February, May, August, and November expirations. And the third cycle is the March, June, September, and December expirations. So all options fit into one of those 3 cycles. So what I did was I studied the price data on option expiration day, and that helps me determine how far out or which expiration month I should use when I decide to purchase a call option on a stock. For example, Apple uses the January, April, July, and October expiration cycles. So the Apple option expiration cycle, if you wanted to trade the January options, they're usually available 6 months prior to expiration, which would be in July. And if you trade the October options, again, those options become available 6 months prior to October or in April. And also, like most other stock options, Apple also trades monthly options for all 12 months of the year, but the monthly options that are not in the Apple January, April, July, and October expiration cycle, they don't become available to trade until just 2 months prior to the monthly expiration. For example, February is not in the Apple option expiration cycle, so the February options become available for trading 2 months prior to expiration, which would be December, and the Apple March options become available to trade in January. So now this price table I'm displaying here displays the price of Apple stock on expiration day for each month in 2007. So on January 19th of 2007, that was the third Friday of the month, Apple stock was trading at 88.50, and on February option expiration, Apple was trading at 84.80. And this table also displays the monthly gain or loss in the stock. So between January option expiration and February, the stock lost 4.2%. And I also display the 3-month returns here. So on April 20th of 2007, the 3-month return for the April option, which you would have bought here in January when the stock was trading at 88.50, on April 20th the stock was trading at 91. So the stock had a 2.8% return for that 3-month period. And on April option expiration, if you bought the July options, you can see here that during that 3-month period, the stock had a 57% return. So what this allows me to do is track the monthly gains for Apple stock on option expiration day, and it also tracks the 3-month profits for Apple stock for the Apple option cycle, which again is January, April, July, and October. And then I also track the 6-month price movement of Apple stock for the January and July options. Now I had 50 months of price data for Apple stock, and what I found out was that if you bought the monthly Apple options, 73% of the time the stock went up in price. And if you go a little further out to the 3-month options, our accuracy rate goes up to 88%. So 88% of the time when you purchase a 3-month option in the Apple cycle, the stock price went up. Now it doesn't necessarily mean the price of the Apple option went up that much, because of course the options are leveraged and they also have time value, but by tracking the stock price, it gives us a general idea of the accuracy and how far out you should go with your options. And with the 6-month cycle, the stock was up 88% of the time with the 6-month cycle also. And what I don't display here are the Leaps options. Of course, they're available each January, and if you purchased the 4 Apple Leaps options over this 50-month period, all of the Leaps options were profitable. So this helps us decide which expiration month to use when you're purchasing an option. And in the case of Apple, if I was going to purchase an Apple option, I would probably go with either the 3-month cycle or the 6-month cycle, as I know that has pretty high accuracy. Okay, and the last strategy I'd like to cover today is the MVP option cycle spread strategy. This spread strategy is implemented by purchasing a stock or a Leaps option and selling a 1-month option that creates a spread that profits from the very rapid time decay of the short-term option. Each month, another short-term option is sold, and that allows us to generate monthly income. Now, the sale of the 1-month option is covered by the underlying stock or by buying a long-term leaps option. Now, for new option investors, this strategy may be a little difficult to grasp initially, but I think it's well worth the effort, as this strategy has one of the best risk-reward profiles available. And let's take a look at a recent option cycle spread strategy trade that I took. Monsanto qualifies as an MVP trendline strategy stock, and my brokerage confirmations right here show that I purchased 3 of the Monsanto January 09 leaps options. Now these expire in about 13 months, and I purchased those for 43.51 points. It's a little hard to see there. And I sold 3 of the Monsanto January 08 115 strike calls. Now the January 08, I purchased these on December 21st, which was December option expiration. So the January 08 115 strike calls that I sold here expire in a month. And I sold those for 3.96 points. So the cost of this spread was $3,955, and we calculate the cost by subtracting the $396 I received for the sale of the 1-month option from the cost, from the $43.50 cost of the leaps option, and the net result was the spread cost $3,955. Now Monsanto stock was trading at 111.50 at the time I initiated this spread, so that the sale of this 115 strike call was an out-of-the-money option, and of course out-of-the-money options consist of only time value, and options lose all their time value at option expiration. So in 1 month I get to pocket this $396 regardless of the price direction of Monsanto stock, whether it goes up, stays flat, or goes down. This $396 of time value I get to keep. Now at January option expiration, which was last Friday, Monsanto stock was trading at 105. So the January 115 strike I sold, the 1-month option, expired worthless, and I sold the February 08 95 calls for $8.10, or 8.10 points, which is $810. So again, to initiate the spread, I bought the 3 leaps options. I sold the January 08, which is a 1-month option, and then at January option expiration, I sold 3 of the February 95 calls. And this process is repeated every month for the life of the leaps option. Now February 15th is February option expiration, and I'll sell 3 of the Monsanto at the money calls, whatever that price is on February option expiration day. And we just keep repeating this process every month until the leaps option expires. So the bottom line, this allows me to sell 12 of these monthly options, and if you total that up, this trade has a $9,600 potential cash income, and my initial investment was $3,955. So that's a very good return for a strategy, a low-risk strategy like this. And again, you can sell this this monthly option every month, regardless of whether the stock goes up or down, and it generates this monthly cash income each month, which can really add up here. Like I say, over a 12-month period, I could receive up to $9,600 in income. Now, one other advantage of this strategy is if Monsanto stock decreases, then the short option can be rolled over, and this can increase your income. And for example, I sold the February 95 calls for Monsanto. Now, if Monsanto stock drops to, let's say, 90 or 85, then I'll buy back this short 95 call, make a profit on that closeout, and then I'll sell another February call with a lower strike price, and that will increase my income. So this is a very flexible strategy, and as long as the stock keeps going down, you can keep rolling over the short option, and it'll increase your income as you roll over. And lately I've done a lot of rollovers with these spread positions because the stocks have been going down. And for example, for Apple stock, I know that's gone down considerably lately, but over a 30-day period, I collected almost 45 points of time pressure, or of time value, or time profit, by rolling over the short option into a lower strike price. So that's a really good strategy for down markets, because you can keep rolling over this short option as the stock goes down in price. Now, these spreads also work as bearish spreads. For example, I bought the China FXI. That's an ETF, and it's the 25 largest Chinese stocks. I bought the January 09 190 put at 47.10, and I sold the FXI February 08 157 put at 970. This particular option has strike prices for each dollar. In other words, there's a 155, a 156, a 157. So the FXI was trading at 157 when I initiated this spread. So I was able to collect $970 for this 1-month put option, and that brought the cost of this spread to $3,700. And I have 12 months of option premium I can collect on this put spread, and that's, if you total that out, that's about $11,600 in potential cash income on a $3,700 investment. So again, that's a pretty good risk-reward profile. And here's one other example of a bearish spread. I bought the oil service ETF. I bought the January 09 185 put at 33.60 and sold the oil service the February 08 160 put at 775. And again, at February option expiration, I'll roll over into the March, and at March option expiration, I'll roll over into the April. So each month I get to sell this kind of a premium against my initial investment. So with this oil service spread, I've got $9,300 in potential cash income on a $2,585 investment, which was the cost of the spread. So again, this is a very good strategy for these types of markets. And you know, I recommend this type of strategy. It's a little lower risk than just purchasing a call option or putting on a debit spread. So that seems to be the best strategy for today's markets. So that concludes my discussion of the strategies, and I would welcome any questions at this point.
If I could take a moment here and talk a little bit about the World Cup Advisor website, where everybody views your history, your bio, and as well as some other information. If that would be all right before we take the questions, and then we could go to the questions after that.
Yeah, that sounds good.
Okay. Some of you may be familiar with the World Cup Advisor website. It's currently loading up here, and I'll just quickly go through this. In reference to Chuck and what he's doing, it's a good place to go and view some history of Chuck's trading since inception of the account at the World Cup Advisor website. So if I can take a quick second, I'll show you how to view the website pretty easily. Some of you may be familiar with this, but this is the home page on the website. Very quickly, all our top traders are listed here. We have stocks, futures, and forex trading here. You can see here in the right-hand corner, there's Chuck's information about the webinar. The best way to view the website, in my opinion, is to start by looking at the biographies of the various traders. Chuck's biography is listed on here. If you click on the left-hand column, under Advisors, you'll see Chuck's picture there. You simply click on Chuck's picture. It'll give you a description and biography about Chuck's style of trading, as well as a short synopsis of his trading account. So you could quickly look at this, view the number of trades Chuck's done, also look at the risk parameters he expects for the account, how long he's going to be in the trade for, how he enters and exits his trades, things like that. Now that you've viewed this, maybe you want to go and look at Chuck's performance. You could quickly do that by clicking on Performance on the left-hand column. Chuck's performance he's been our lead stock performer at the website for quite a while. All of this information is compiled in real time, so we're listening to these accounts live, so you can hear so you could see what's going on in the leader's account live and watch what he's doing. Anytime there's a trade made or an order changed, you would receive instant notification as a member of the World Cup website. When we're looking at the performance here, we want to quickly look at the performance on a net basis, so we do that by looking at the net profit calculator here. We can do this simply by clicking on the net profit calculator, which is located in the upper right-hand corner on the performance page. There's a pull down here where you can pull down Chuck's information. In that pull down, you can see there that we pulled up Chuck Hughes' MVP strategy portfolio. We put in a commission rate, the number of trades, and the subscription rate. Then we click Calculate. Once we do that, we can quickly see how Chuck's doing here on a net basis. This gives us performance for Chuck's account since inception. The inception of this account happens to be March 31st, 2005. The gross profit in the account is $214,000, and as you can see, it's updated through today. The net profit in Chuck's account, after all fees are taken out, is 76%. So very respectable performance there. If you wanted more information about this service and you had any questions and specifically you wanted to ask that to us, you'd simply have to go to the button on the right-hand column here as we're pointing to it. Click on that, request more info, and someone will be contacting you from the World Cup Advisor website to answer your questions or to help you get through the website. So if you do have additional questions, there's the info page. Please fill in your information and we'll be quick to respond there. So at this time, if you have any questions, we'd be glad to take them. You could simply type the questions in, and Chuck can read them there and answer them at his convenience. Thanks, Chuck.
Okay, thank you, Ed. Okay, here's a question from Mike. for the leaps strategy, how do you decide when to roll over the short option if the price of the stock drops or rises? Usually what I do, Mike, is let's say I purchase. Well, let me use an actual example here. Let's go back to the Monsanto example. Okay, I'm going to pull up my slideshow here, and we'll go back to that slide, and we can talk about the short option rollover, which I've been very actively doing lately. Okay. Yeah, when I first initiated this spread, Monsanto was trading at 111. So it's subsequently, at February option expiration, it dropped down to about the 95 level because I usually sell an at-the-money call at expiration, an at-the-money 1-month call. That gives me the best time value premium, which is the goal when you're selling an option, of course, is to maximize that time premium. So Monsanto was trading around $95 at January option expiration, so I sold the February 95. Now let's say Monsanto drops to 90 a week after I established this this new short call. I would go ahead and buy back the 95 call, and I would realize a profit on that because the stock's gone down in price. And I would go ahead and sell the February 90 call, which is a lower strike price and a premium than the short 95 call. So I would roll that over if it drops to about 90. If it drops to 85, then I would roll over the 90. I would buy the 90 call back to close, and I would sell the 85 call, and I would just keep rolling over at roughly $5 increments. And I noticed when I got this month, when I got about a week before January option expiration, I was still rolling over into the January options, even though there was only a week, maybe a week to 9 days left till option expiration. I was still rolling over into the January calls because they still had enough time value to make the rollover worthwhile. Now, once I got within a week of January option expiration, then I would roll over into the February options. In other words, I would close out the short January option and sell a February option once I get within 1 week of option expiration. And these spread orders, by the way, can be entered as spread orders. In other words, when I bought the January 09 75 strike leaps option and I sold the January 08 115 call, I entered this as a spread order, and that's why you see this odd fill price here, 396 and 43.51. It's because I entered this as a spread order, and what I usually do is I will split the difference between the bid and the ask when I put this spread order in, and I normally always get filled that way. So that reduces the cost of the spread trading when you enter this as a spread order. And I also can do that online too with some of my brokerage accounts. Now, when I rolled over at January option expiration, the 115 call expired worthless, and I sold the February 95 call. In this case, I didn't have to enter this as a spread order because the January expired worthless. But if Monsanto stock had gone up and I had to close out the 115 call, and it didn't expire worthless, then I would also enter this rollover as a spread order too, and again I split the difference between the bid and the ask, and that way it reduces the cost of the spread trading. So and then if Monsanto stock drops to 90 and I buy to close the 95, sell to open the 90, again I'll enter that as a spread order. So I've been very active in the last several weeks rolling these over, but it keeps my risk to a minimum, and you can even make money as the stock is going down. And over a 1-year period, when you can collect this type of premium on this investment, that's a pretty low risk strategy. Okay, I'm going to look and see. There's other questions here coming through real quick. It says, the question I was going to answer just jumped. Okay, what factors, this is from Bert, what factors do you use to pick a stock for the spread strategy? Bert, I use the MVP trendline strategy to pick stocks for the bullish calls, and I also use the MVP trend strategy to pick stocks for the bearish spreads. In other words, obviously if you're going to put on a bullish spread, you want the 40-day trend line above the 80-day trend line, and if you're going to do a bearish spread, you want the 40-day trend line below the 80-day trend line, unless of course it's a reverse or inverse bearish ETF, then of course you want the 40-day above the 80-day. So for the example I used for the FXI, the bearish strategy, the 40-day trend line was below the 80-day trend line, and the other bearish spread I put on recently was the oil service holders, and again the 40-day trend line for that ETF was below the 80-day, and therefore I put on a bearish leaps spread strategy or spread trade. Okay, this is Rick. So call your leaps and then do the process all over again. I'm not really sure what that question means. Let me go to another one here. Here's a question from Mark. Do you exit the whole spread if the 40-day EMA and 80-day EMA cross back on each other? But Mark, if I have a bullish spread on, let's say for Monsanto, and if the 40-day trend line drops below the 80-day, then I would probably just exit the spread, as Monsanto is no longer in a price uptrend. So I would just exit the leaps option in that case, and I would close out the short-term option. And again, that can be entered as a spread order, and that'll allow you to save money on the spread between the bid and the ask. Okay, I'm going to see if I can answer any more questions here. Here's a question from Patrick. When you decide to buy an option, how do you determine which option, strike price and expiration month, to purchase? Well, Patrick, we covered the expiration month, and in the case of Apple stock, if that was in an MVP trendline buy mode, with Apple, I would probably, based on that historical data that I presented for Apple, I would probably buy the 3-month or 6-month expiration option based on that historical data, because I know that has a high percentage of winning trades over the past 50 months. And then as far as the strike price, when I buy call options, now I'm not talking about a spread here, but if I just buy the call option, I normally will buy an in-the-money option that has less risk than buying an at-the-money or out-of-the-money option. And I have some information on that in my MVP book as far as the advantages of buying in-the-money calls as opposed to buying at the money or out of the money. So I fully explain the reasons why I prefer to buy in-the-money calls. Okay. Let me see if I can find another. Okay, this is from Gordon. Is there one strategy that I could specialize in that works great in all markets? Well, Gordon, I would have to say that this leaps option strategy is the best strategy for all types of markets. And so I would focus on that one as being the best strategy as far as the risk-reward profile. And it has a good return, and it has very low risk compared to, say, just buying a call option. So I would focus on that strategy, as I think that's the best strategy when you take risk and reward into account. Okay, here's a question from Steve. What happens if you get the option called? Steve, in my experience, I've been doing these options for 24 years, and if I have a spread trade on where I'm long a call option and short a call option, as long as the short call option has some time value in it, normally, in my experience, it won't be called unless the stock is it pays a big dividend. And there have been a few, out of all the thousands of trades I've taken, a few times I have been called on an option on the dividend date. In other words, the stock was being called, and I'd wind up being short the stock in my account, and I'd have to pay the dividend by virtue of being short the stock. So once that happened to me, and I noticed it was only with stocks that paid a high dividend. I had a Goldman Sachs option spread on several years ago, and that happened. So the stock was called. I wound up short Goldman Sachs stock in my account. So I called my broker, and I exercised my long call, and that closed the spread out. In other words, I was exercised, and then I went ahead and assigned, and that closes the spread out, because you buy the Goldman Sachs stock at the strike price of the call that you purchased, and you sell the Goldman Sachs stock at the strike price of the call you sold. So they cancel each other out, and then I was flat. But I did wind up having to pay the dividend. So I normally don't put on spreads anymore with stocks that pay high dividends because of that reason. So, but to answer your question briefly, the options rarely ever get called if they have time value remaining, and it's only happened to me when again when I was short a dividend paying stock. And we'll look at some more let's see. This is from Lewis. Is that the same as a moving average? And I think, Lewis, you're referring to the trend line. And my colleague, John Weston, he likes to use the name trend line, and I like to use moving average. But they're both basically the same thing. And John helped me write the MVP book, so we stuck to his terminology, which is a trend line. But to answer your question, yes, the trend line is the same as a moving average. And I got the same question, it looks like, from Jim. Is the 40-day trend line weighted equal to a 40-day exponential moving average? And Jim, the answer to that is yes. Let's see here. Here's a question from Norb. Wouldn't you be expecting to be called out on your February 95 in the money call? You said the price of Monsanto was at 105. And again, I would not expect to be called on the February 95 if it's in the money. And again, my experience has been that I have not been called on in the money calls unless again they're a dividend paying stock and there's a dividend date coming up. Okay, I think that answers most of the questions, and I just want to thank everybody for attending today, and thank you, Ed, and if you have any more further questions, I'm sure Ed at World Cup Advisor would be glad to answer your questions. So thanks again, and good luck in trading in the markets. This is Chuck Hughes signing out. Thank you.
Thank you very much, Chuck. Great job. Thanks again, everybody, for attending. Look forward to seeing you again back here in the coming weeks. Keep your eyes open for the new and new announcements about the next advisors who will speak at the webinar. And I'd like to thank Chuck again for a very informative seminar. Hopefully it helped all of you. If you do have any questions, again, click on the button to your right that's got Chuck's picture there, and you could put your information in, and we'll immediately respond to you and be glad to answer any questions. Thanks again, and have a good night. See you soon. Bye-bye.